Good afternoon, everyone. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at those, we'll also take a quick look at the U.S. dollar. We'll see how it's faring, how it's affecting gold, silver, and Bitcoin. Once we finish looking at all those, we'll also take a quick look at any chart requests if anyone in here has any. If you're in here, feel free to add it into the chat. I'll be more than happy to take a look at any charts you guys are looking at. If you like what you see, you can always follow me at StockDarts on Twitter. You can find these videos on YouTube under the same name, StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, as well as generally just expanding on some of the information we come across on these Wednesdays. Typically what I like to do is try to analyze what kind of market environment we're in and then tailor my trading style to match that. So if we're in a range-bound market, I'll be looking at range-bound strategies. Same thing for momentum markets, whether it's going up or going down. Let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. We're going to look at it through the ETF SPY. And as you can see, we pointed out this broadening wedge last week and how volatility was increasing on the markets in general, and how that was likely going to lead to a series of chopping back and forth as the market tries to stabilize. Right now what we have is we have a pretty wide disagreement between the sellers and the buyers, trying to figure out where the market wants to go next. And we've had an interesting trend where we start the week off strong and then fade pretty sharply towards the end of the week. You can see we've actually done it for a few weeks now, where we start big, and then kind of fall apart, then go big, fall apart. And again, we've kind of ramped up over the last few days. And this week looks like maybe it's a little bit different, but you never know. It's only Wednesday, and we have now found ourselves right back to the top of that broadening wedge. We're trying to push through that, trying to get back above. We got back above the 20, and we're trying to get back above the middle of this channel and towards the top of it. And there's a chance that we do that. It looks like we found some really good support here as we've threatened to break down. But like I said, with the volatility that we are experiencing in the markets right now, the only thing we can really count on is the fact that we can't count on anything. And so I don't think it's a great environment to be trading too aggressively. I think this is the kind of time where you want to be a little bit more cautious about how you go ahead and approach trades, and make sure you're extra picky about the charts that you want to look at, and not get too caught up in what we're seeing here. We're also seeing a pretty drastic change in character with what sectors are doing well and what sectors aren't. Now this is of course a trend that we've pointed out now for several weeks, so this is not a surprise, and it's not anything new to any of you guys that are regular viewers here, and that is that the tech names, and particularly the quote-unquote stay-at-home names, the names that have benefited from us kind of being quarantined, have continued to struggle as money continues to rotate from them into some of the quote-unquote recovery names, the names that are going to start to benefit as we open up and get out of our homes and start going out again and traveling and all that sort of good stuff. So that rotation has been in place for a while now, and we've seen it with an increase in the Dow Jones and IWM as they've become the leaders. Particularly IWM has been the leader for the most part over the last several months, but the Dow Jones has picked up some strength recently as well, with airlines starting to perform better, and some oil names and some other industrial names that maybe we'll take a look at later in today's episode. So overall, this has become a different market from what we've seen over the last year. Throughout 2020, we could always count on the tech names to do well. I still think that the tech names will provide us a very nice bounce once they really stabilize, and we are seeing a bounce in a few of those names recently, like Tesla. But generally speaking, they are still not really at a spot where they make sense as the best purchases, but I think that that's an area that we should be looking at in the near future, because they should bounce again. And I think ultimately, as I've said quite a bit over the last month or two as we've discussed this rotation, I think the pattern of us working and shopping and consuming from home was something that was in place and something that was developing long before COVID. And while the coronavirus and our response to it accelerated a lot of that growth and a lot of that transition, I think that pattern is here to stay. I think people are going to continue working from home. I think a lot of corporations are going to give their employees the opportunity to work from home. Maybe not every day of the week, but at least 2 or 3. I know a lot of friends in the corporate environment that even 2, 3 years ago, they've already were working from home, say on Fridays, as their companies made it a little bit easier for them to kind of do that if they could. And I think with the way we've transitioned, and I think with the success that a lot of companies have had with their employees staying at home, I think that that's a pattern that's going to stay. So I think a lot of these tech names that benefit from us working from home, shopping from home, I don't think that that's going away. So I think that those names still provide us with good opportunities once they stabilize and find good areas of value and are ready to bounce. So that's kind of where we stand as far as the markets. The Nasdaq, like I said, we'll get to them in a second as we go into each individual index. But the Nasdaq is kind of struggling. The S&P 500, again, as an aggregate, shows us what the market is doing as an average. And then, like I said, the Dow and IWM are the ones that are leaders, which we'll get to. Just a quick heads up, my internet service went down right before 12:30, and then luckily it kind of came up. That's why we had a couple of, a few minutes delay as we started. So if for whatever reason I cut off, just understand Comcast is being a little finicky today in my neighborhood. So there's a chance that my internet just cuts off. And if that's the case, then I'll tweet it out through my phone and let you know that basically the stream is probably ended. But just to give you a heads up in case things cut off and I don't come back on, the internet was starting to act a little bit weird today. All right, so looking at the S&P 500. Just in a nutshell, in a vacuum, not comparing it to the other indices right now, you can see we're still in a very clear uptrend. The market is still climbing very steadily. We have, like I said, had increased volatility, and we did have a breakdown, or a threaten of a breakdown, as we broke below the 50 and below the bottom of this channel. You can see these two candles that we formed to close out last week and to start this week. Actually, to close out last week, because that hammer candle was on Friday. But basically, the market threatened to kind of shift to neutral. This is something that I still think is probably in the cards. I think that as we move further into March, and particularly as we head into April and May, I think that this rally is going to kind of taper off, and we're going to transition to a more sideways market, like we're starting to see on the Nasdaq and we're starting to see on the S&P 500. But until we have all four of the indices moving together, it's going to be harder to really predict exactly how that's going to play out. But if that's the case, typically what happens in these scenarios is you start to, the price action starts to erode, and the way that happens is you start to challenge these different technical indicators that kind of give us a good sense of what the market is doing. So it first starts with challenging of the 20-day moving average, and then it transitions to challenging the 50-day moving average and perhaps some of these longer-term trends. And eventually, the more often you challenge them, the more likely that they will eventually break, and you'll eventually, they'll lose some of their significance, and price action will start to ignore them. So typically, the way that works, like I said, is you have a defense of a certain area, and it is defended once, twice, 3 times. Then eventually, the people that were defending it break, and they let it kind of go. And then the next level becomes the defense area. And so what we're seeing now is the 50-day has been tested 2 or 3 times now, and it actually was kind of temporarily broken as the sellers were able to gain control of the market last week towards the end. And like I said, pushed it down pretty quickly from Tuesday to Thursday before we found some buyers on Friday. And so there's a chance that over the next couple of weeks, we continue to challenge these areas. You can see the 20-day moving average is already flattened out. The 50 is still holding pretty strong. Obviously, the 200 is still holding strong. So I think our long-term trend is still very much intact. And I don't think that we are transitioning to a market that's ready to top out, as I've said before. I think what we're seeing now is a rally that's getting a little bit long in the tooth. And what we need is, we need the people that are taking profits now to kind of conclude with that selling. And we need new buyers to step in and take over the mantle of ownership for the market at what they consider to be good values. So in my mind at this moment, even though we're technically still in an uptrend, I think the market is already flipping towards one that's looking for support and looking for value. But we still have some buyers that haven't gotten the memo or are still trying to take advantage of this trend and are kind of buying it up a little bit quicker than probably they should. And so that's why we get this back and forth chop, is because you have a lot of people taking profits or anticipating high resistance, but you have people that either missed out on this move or want to get back in this move that are jumping I don't want to say early, but are jumping quickly and aggressively to kind of support the price action. And again, some of that is going to be reflected in the Dow and IWM, where it shows that they're doing it with success and for good reason. But when you look at it on the S&P 500 and the Nasdaq, you can see that at this point it's actually, you can see the price action slowing down, and it's more likely than not that you need to be more cautious and wait for support to really establish itself before you want to get too aggressive playing to the long side. Now, what are the key levels we want to watch here on the S&P 500? Well, besides the 20 and the 50, which I've already kind of pointed out, which I think are the kind of the key short-term price points, I think in the intermediate term, you can see that we're starting to develop this 372 area as kind of an important zone. There's been volatility around that area a couple times now. It actually started way back here when we were first approaching this area to break above it. You can see we had this big wick and then the big sell-off that day on December 21st. And then eventually we were able to kind of push back through, and again we had a big volatile sell-off before we were able to make our way above it and actually break decisively above this 372 area. And then when we came back and tested as support, again you can see a lot of volatile candles as we came up and tested that area. And then again the volatility has led right back to 372. So I think at this point on this SPY, 372 is kind of a critical area and should act as our immediate floor in the event that we lose this channel and we continue to break below our moving averages. And that should be looked at as a decent opportunity to go ahead and take some shots at bounce plays, with the understanding that the market is transitioning towards a more negative environment, so there's a chance that we lose that level, right? But for the moment, that looks like a pretty decent spot to go ahead and take a stand with some particular bouncing, bounce plays or support plays. With the understanding, though, that there's a chance that we need to come down and test the 200, which has not been tested in a very, very long time. And like I said, I don't think at this point we need to worry about the 200 getting tested, but we should understand that if we lose 372, there's a pretty good chance that that means we're going to come down and test either at or around the 200. So those are kind of the key areas to the downside we want to watch. Is one, we want to watch this 50-day moving average and this trend line, which is not that critical. Unlike the other indices where the trend line makes more sense, this trend line is more of an approximation of what the trend looks like. I'm not really connecting that many points on here other than maybe the last couple. So I don't think this trend line is really that relevant to us making decisions off this chart, but I think it gives us a good visualization of what this trend has looked like. I think what's more critical right now is the 50-day moving average and seeing if we stay above that. If we lose that 50-day, then we're going to come down and test these wicks from last week. And again, this entire area, which as you can see pretty clearly, has been a decent spot for the bulls and the bears to kind of fight over control of the price action. Now, there is the possibility that the Dow Jones and IWM continue to pull the market upwards, in which case the S&P 500, as we can see, is actually breaking outside of this wedge. If that breakout holds, then we kind of make our way up. But as you can see, overhead resistance is pretty close. All-time highs are right here at about 394, and recent highs are right around 392, 393. So we've got 3 or 4 points before we hit some serious resistance and some serious levels where there could be a lot of supply waiting. But if we do break past that, then I think it's a quick run right back up to the top of this channel, and there's a decent amount of opportunity here for it to run up. But like I said, with the cross currents that I'm seeing in the market, it's not the scenario that I see to be the most likely, but it is a scenario we need to keep in mind, because after all, we are still in a strong bull uptrend, and even though the price action has shifted and it's starting to kind of lose some of its luster, we're still holding up, and the bulls are still coming in and supporting it. So there is a chance that we push our way back above 393 and start making our way up, but the risk reward's a little bit difficult to really pin down right now, because really we've got support down here at 372, and we've got resistance up here around 4 or 5 points away, and maybe 7 or 8 points away if we get a really big run. And so I don't know that it's really that great of an opportunity for us to try to take too many shots. And like I said, with the constant back and forth that we're seeing in the market, it's difficult to get too aggressive with any kind of confidence, because the market is really just kind of shifting back and forth, and faking out a lot of traders and just kind of churning and getting us into trouble. All right, so I think the most likely thing that we do is probably just try to keep pushing up and then hit some resistance and then come back down and test the 20 and possibly the 50 again. And I think that's really where we'll probably stand from here to next Wednesday, and then see where we go from there. Now, in contrast to that, we'll see with the NASDAQ. The NASDAQ is definitely in a lot more poor shape. We had a pretty tight channel. It was very bullish. And then it's recently kind of lost, like I said, a lot of momentum. You can see volatility increasing. It was trying to stabilize here around this range between 323 and about 312, 310. It failed, and it pulled all the way back down to about 292. And you can see we found good support here, and we've made our way back up, but we're still struggling to get back into our recent ranges. And if we take a look here, we did find good support right around the highs from last summer. And, you know, at the moment it looks like the market, like I said, the NASDAQ is still struggling, and there's a decent chance that it fails again and has to come back and test that level. But this is a key level. This is an area we were really looking at. And I suspect that if we do come back and test that level again, that it will once again be a good support spot and a good place to go ahead and take some buy the dip plays on some of these bigger tech names that have begun to struggle a bit. Now, what we're seeing here, like I said, is a development here where we're losing momentum. We started to break through that channel, and as you can see, typically what happens when you break out of these channels, you come down, you find buyers, you come up, and then really that retest is kind of the key. Whether it's just a temporary drop, like we saw maybe on the S&P 500, or whether it's going to be something that's a little bit more prolonged, like we're seeing on the NASDAQ. And as you can see, we tried to get back above the 50 and above this trend line, and we failed, and we just kind of quickly dropped 3 or 4 days in a row before, again, we found some stability and some buyers right around 300, which, again, is a big round number and is also a previous level that's kind of critical. Now, we're coming right back up. We're testing that. You'll note the 20 and the 50 have lost a lot of momentum. The 20-day moving average is actually curling down. I'm going to zoom in a little bit. And you can see the 20-day moving average is coming back down and crossing the 50. This is a good signal for us that this trend is likely done. As I've said before, and one of the keys that we were paying attention to when this rally first began, a lot of times the moving averages give us a good idea of what's going on. They give us a clear picture of maybe what the charts are doing. And when you have the 20 and the 50 kind of moving up in a 45-degree angle parallel to each other, that's usually indicative of a very strong trend, and one that you want to follow. When they flatten out like this, this is obviously, as if you couldn't tell with the breakdown to begin with, this is a good signal that this trend is probably done, and we've transitioned to a more sideways market that's going to need us to go back and forth through the moving averages a few times before we can really get to a spot where we can trust the price action again and start making our way back up. So again, a lot of selling pressure on the NASDAQ. You can see that the trend has shifted to neutral. It's no longer bullish like it was throughout the start of this year and then the end of last year. And so there's a decent chance, like I said, that the other markets are going to have to kind of come to terms with this, because we're going to see a very different picture now when we switch to the Dow. And when you have markets like this that are in disagreement, usually what that does is that leads to a chop. That usually doesn't lead to strong trends, because you want all four indices moving together. And the fact that the NASDAQ is really struggling is a good hint that the overall markets probably need to trade sideways, even if we are seeing strength in the Dow and IWM, which, like I said, we'll get to in a minute. So I think, if anything, the one thing I want to point out with the NASDAQ is that this leads more towards the argument that the markets might need to trade sideways, because money has rotated out of these areas, but for the most part, the tech names and the FANG stocks in particular, they've been the leaders for a long time now, and I think, if anything, represent what our economy is more than, say, the Dow Jones Industrial Average does. And so the fact that the tech names are starting to get hit a bit, I don't necessarily see that as a positive. Although, like I said, I think more than anything, I think it just shows the attitude in the marketplace is that they expect money, the money's flowing back towards recovery, because they expect us to start recovering and to start putting money back into some of these businesses that have really struggled over the last year. And like I said, we'll get to that in a minute. Let's take a look real quick at some of these FANG stocks though, so we can see if it's reflected the same as on the index. And you can see again, Facebook has already tested its 200-day moving average quite a bit. It's trying to stabilize. It looks like it's found a decent area here as support, and could be, like I said, maybe giving us some opportunities once we see this stabilize a little bit more. Amazon, which is next in line, again has really struggled, but it's come down and it's tested some long-term support areas, right? If we come back and we really take a look, and we'll extend this trend line out, we can see what's happening here. We came down, again, look at the 20-day and 50-day. They've been sideways for a while now, showing that underneath the surface, the tech area was kind of already shifting towards neutral. And they've come down, they've actually broken below their 200, and they're coming up and retesting that. If they fail here, they're likely to come back down and test 2,900. But again, I think that this might be a good buying opportunity, because if the markets are going to continue to climb or trade sideways, then the tech sector will eventually rebound. Now, if the tech sector starts to fall below these big support levels, I think they will drag down the Dow and IWM, regardless of whatever kind of rotation the market might have in its head. So that's another thing to really keep in mind. Now, if we look at Apple, same idea. The moving averages have kind of turned over. We're coming back and testing the 200. Netflix is going to be in a similar spot, again testing the 200-day moving average. And Google, which is the one that's different, is actually still holding up very strong. And even then, they've lost their 20-day moving average and had some big selling pressure this week, and might need to come back and fill this gap and test the 50. But this is kind of the one FANG stock that's a little bit different. And then finally, the last one, which is not really a FANG stock, but I think has become a leader as well, is Tesla. And we can see Tesla also had a pretty big breakdown and lost some momentum, but was able to rebound very sharply yesterday. And as of today, is starting to make its way back above and through this recent trend that's been developing, bearish trend that's been kind of pushing the price action down. So, like I said at the open, for those of you that kind of joined a little bit late, money right now is rotating out of tech and rotating into some other names in the retail space, travel, oil-related names, energy, and any names that basically are expecting a recovery from us being vaccinated and kind of coming out of our homes, while a lot of these names that benefited from us staying in our homes have been hit. I still think that these names will rebound and will do well, and so we should be looking at all of these FANG stocks and other names that are related to them as they set up support areas, because I still think that's a trend that will be in place as we move forward. But I'm still seeing selling pressure there, so until I see more clear reversal patterns, it's difficult to recommend taking that trade at the moment. Now, like I said, how does that reflect with the NASDAQ? Well, it's the same thing. The NASDAQ at the moment has had a nice bounce, but it hasn't really broken this recent downtrend that's beginning. So we need to see a shift, and we need to see it break through this and get back above its moving averages before we could get too excited about trading tech names to the long side. Now, we take a look at the Dow, and it's a completely different picture. We have a breakout to new all-time highs. We had an attempted breakout 2 days in a row that faded, but we were able to push through that. So this is a very bullish sign, and it's kind of weird because we had a very bullish, and we'll zoom in. And this, I think, shows the disparity in the market and some of the discord that we're seeing right now. We had a very bullish candle followed by two very bearish candles, and then now we had a series of pretty bearish candles that have been followed by very bullish candles. So we still have that back and forth in that chop. But what the Dow Jones is doing is it is actually making headway and moving forward and breaking to new all-time highs. Now, if we extend this channel a bit, we can see that it's basically still trading in a pretty clear channel. And it did fall outside of that channel temporarily, but it found support at the 50 and the 20 and was able to rebound and make its way back up. And like I said, it's pushing upwards. So what does this tell us? That again, a lot of these names, and what we're going to do here is I'm going to go to FinViz real quick. We're going to go to the screener, and we're just going to look at Dow components. Right, and so these are the 20 Dow companies, right? So you've got Apple, AMZN, Amex, Boeing, Caterpillar, Salesforce, whatever. I'm not going to read them all, but these are the aggregate, and a lot of these names were hit pretty hard, particularly stuff like Boeing, Caterpillar, Chevron. They were hit very hard when we had to kind of quarantine. and stay home. And a lot of these names, as we look at their charts, have finally recovered and have finally started to bounce. Um, you can see Boeing has made a nice recovery. Caterpillar has been doing really well. Um, Chevron has had a massive move. Disney, another one that got hit pretty hard, has started to make some strong recoveries. Um, Goldman Sachs. So basically, a lot of these tech names, or a lot of these industrial names, um, have recovered, and in doing so, has finally propelled the Dow Jones back towards highs. And so, I think that this, more than anything, gives us a good idea of what kind of rotation is going on here. When you see the FANG stocks struggling, and you see a lot of these names like Caterpillar or Chevron recover very strongly, I think it's a pretty clear indicator of a market that's anticipating a much more full recovery than we've seen so far, and these companies to kind of get back to business as usual like it was maybe in 2019 and 2018. So I think that's what's being priced in right now. Now, a lot of those names are starting to get extended. As you can see, the Dow Jones is starting to get a bit extended. It's right back to the top of this channel. So the big key is what happens when we see some profit taking in this area. Does it go back into the tech, or does it just go into accounts as money waiting for a dip so they could rebuy these names in the Dow and IWM? And so if that's the case, then we'll see all four indices kind of drop back. But if it just rotates back into the Q and the SPYs, the Qs and the SPY, then maybe we see the Dow Jones and IWM taper off a bit while the other two kind of play catch up. And so I don't think it's clear at the moment what's going to happen. But what we're seeing here, like I said, is a pretty clear shift towards the Dow and IWM, and it's been in place for a while now. It's something we've pointed out for several weeks now, and until it changes, this is where we should be looking. But we should keep an eye on the areas that have kind of corrected, because those are going to be the ones that give us the better risk reward and the better value once money starts rotating back into them. Now, if we look at the Dow, and we're just looking at the technical levels, it's already at theoretical resistance, which is the top of this channel. It could, of course, keep kind of climbing and stringing up along the top of it, as it did, say, back here in January. Or it could kind of come back and retest the 20 and maybe even come back down and test a little bit lower. And I think that's really the next key. Is I think the Dow Jones should taper off here as we close out the week, particularly if we follow the pattern that we've done over the last month and a half, which is basically sell off into Friday. And if that's the case, then we should see a little bit of selling pressure. But ideally now, we have a new level here that is going to be important. So if you're concerned with our bull trend here and you think that there's a very strong likelihood that we pull back, with the Dow and IWM, which we'll get to in a minute, being the new leaders, in the short term, if they continue their bullish momentum, then we should expect the market to continue its bullish momentum as well. So the key here is, you can see this was a big area that we kind of had the big strong bullish candle followed by the very negative candle. Then we came up, and over the last 2 days we've tried to break that area and failed, and we finally broke above it today. So 319 or so is a very important level in the short term. And as long as we stay above that, I think it's all systems go for this area of the market, these recovery names, and they should probably continue to bounce. If we fall back below this, I think it's a pretty quick run to the 20 and to this particular trend line, which does have some relevance, and then possibly even the 50 if we kind of falter here. Again, this is a pretty tight channel. I don't expect the price action to stay inside of it that much longer, but for now it is, and until it changes, that's the way we kind of have to play it. Now, levels to the downside are really just this channel and the 20 and the 50. I don't expect us to lose this series of 3 candles that we formed over the last couple of weeks in 309 or so. I think that's the key area. If we lose that, then we have further to go, but I don't expect that to happen from here next Wednesday. I think, if anything, the area we need to concern ourselves with is this little area right here between about 319 and about 315, 316. Now, the last index we want to look at is IWM. As you can see, IWM is kind of an amalgamation of the S&P 500 and the Dow, and even to a certain extent the NASDAQ. So we've got a little bit mix of everything. We've got the broadening wedge just like the SPY. We have a break below the trend line and below the channel like the NASDAQ. But we also have a run right back close to all-time highs, just like the Dow. Now, this is slowing down. It looks like the Dow is starting to take over the mantle of leadership from IWM, at least in the short term. And what we need to see here is for price action to maintain itself above this broadening wedge. Now, these broadening wedges, this increase in volatility, they are not always harbingers of doom. They don't always signal a market that's going to top out or a reversal in trend. All they're telling you is that there's increased disagreement in price. Typically, what happens is eventually that price, this is going to quiet down, right? Volatility cycles just like price. It goes up and down. What we want to see now is we want to see volatility start to decrease. And if it does so in a beneficial way or a constructive way, it'll do so by trading very slowly as it builds up steam to break out above 229 or 230. If volatility continues to increase, it's probably not going to increase to the upside. It'll probably increase to the downside and come back and test the bottom of this wedge, or at the very least down here at about 212 in these moving averages. So I think ideally what we're looking for with the markets right now is for the volatility that increased as we moved into March, in the first couple of weeks of March, is we want to see this slow down, and we want to see the candles start to shrink a bit as they've done over the last 2 or 3 days, and start to see it trade a little bit more sideways and not necessarily violently swing back and forth with these big red and green candles. So what we see here, again, like I said, is we've got, just like the Dow Jones, we had a breakout above a key level. In the Dow Jones case, it was 320. With IWM, it's the top of this broadening channel. It's above it. As long as it can hold above it, I think that's bullish. Even if we get another series of dojis, which are could hint at a drop, I think as long as we stay above this wedge, or this trend line in particular of the wedge, I think we're okay, and we can maybe try to make our way back into that channel. If we falter and fall back into this wedge, then we're looking to lose the 20. We're going to probably come back and test the 50. So that's what we want to see on IWM and the small caps. I think the small caps in the intermediate term are still probably the leaders. I think in the short term it's the Dow Jones. And long term it's still going to be the SPY and the Qs. But they're the ones that, like I said, are struggling a bit right now because they've been leading for so long now that there's just profits that need to be taken off the table in those two areas and kind of put into different places, which again is energy, travel, and stuff of that nature. Right, so that's the 4 indices as an aggregate. What are my thoughts in particular? I think that the market is still chopping around, despite the fact that we are seeing bullish signals on most of these indices, with the obviously the exclusion being the Nasdaq. I don't think that they are. I think that we're still stretched out. I don't think that we have it timing-wise. I don't think we're in a good spot here. We're up 4 days in a row on IWM, and we're up from basically 212 all the way up to about 226. There's not as much upside right now as there is downside, so I don't think that we're in an opportunity, or in an environment that gives us good opportunities. But I do think we're in an environment that has probably shrugged off a lot of selling, and is probably starting to get more constructive, and is going to provide us some more long opportunities. There is the chance that this reverses again, and if it does so, then we will move all the way back down. But I don't think that's the negative either, because that should give us better value opportunities. I still think that the market is strong, and it's just a matter of us getting to an opportunity or a spot where volatility is more in our favor, and we have better risk reward. And so, and on top of that, more clear signals, which, like I said, at the moment we're getting pretty mixed signals. Every 2 or 3 days, the market looks like it's a completely different spot. And so right now it looks bullish because we're up 3 or 4 days in a row, but it could be that by Monday it looks bearish because we're down 2 or 3 days in a row, as we maybe sell off tomorrow and Friday. So I would say be cautious. I am still more interested, which we'll get into in a minute, with the cryptocurrencies, which are giving me much clearer bullish signals. And I am trading the market lightly as I wait for better opportunities, and I wait for money to rotate back into tech, which I tend to feel a little bit more comfortable with right now than some of these names that have been beaten up. And even though they're recovering, I still trust some of these tech names a little bit more than what I'm seeing right now. All right, so real quick, I don't want to spend too much time with it today, but we look at the U.S. dollar. We can see actually a pretty bullish move, very strong. Was able to get back above a pretty important range. Now, it failed there, right? So if we kind of just make the ends match here, You can see it broke back up into the previous range and then it faltered. But this is a bullish move on the US dollar. So if we look at the euro US dollar cross, we're going to see the inverse of this. And we're going to see a euro breaking down and coming down and testing its 200. And again, losing a pretty critical range that it was developing. So the dollar appears to be gaining strength. This should put pressure on the stock market. It should put pressure on gold, silver. It should put pressure on oil. It should put pressure on anything that's priced in US dollars, including cryptocurrencies. Now, we're not seeing that pressure yet on the market too much, or oil for that matter, or cryptocurrencies, but we have seen it on gold and silver, which we'll get to shortly. There's the possibility that there's going to be a rebound here, and that the euro bounces and puts more pressure back on the dollar. But like it looks like the dollar has definitely bottomed and is now at the very least trading sideways and is actually trying to make headways in the other direction. If we look at the US Japanese yen, you'll see that the dollar has actually made great strides against the yen. I think the yen being the weakest of the three currencies or four currencies that we normally look at. And so the dollar has actually done very, very well against it. And then the one index, or the one currency cross that the US dollar has struggled the most with recently is the Canadian. And you can see it's still struggling. And like I said, I think this is more a function of the strength in oil than anything else. But what we're seeing is we're starting to see some weakness in the euro. We've seen a lot of it in the yen. And so the dollar is starting to show a little bit of strength, but it might just be a function of weakness in those other currencies rather than pure dollar strength. Because again, you can see the dollar still struggling with the Canadian. Now, of course, the reason for that, as we transition into oil, is because oil continues to show very, very strong price action. We had the pullback that we expected around 63 down to the 20-day moving average, and as you can see, it exploded upwards from that and pushed back above 65 and actually all the way up to 67, almost $68 a barrel. We've pulled back, but we're still holding steady. We actually have previous resistance, which should now act as support. And so there's a decent chance that oil rebounds already today or tomorrow, or it comes back down and tests the 20. But either way, as you can see, oil is in a very strong uptrend, and oil names should be reflecting this. And if there's an area of the market that probably is still good to trade with momentum trades and with breakout trades, it's energy. Now again, we're starting to see volatility increase as this trend kind of matures. I think that we're not that far away from it eventually kind of trading sideways and breaking through these moving averages, but not yet. Like I said before, when you have the 20-day just expanding upwards, the 50 spreading out below it, you have a nice width between these moving averages, that tells you that the trend is very strong. And so until we see erosion of this, until we see the moving averages start to get closer together, we can expect this trend to persist. So for now, things are still pretty strong with oil. The opposite of that is gold and silver. As you can see with GLD, really just dropped. And over the last 2 days, it has a little minor pop. But this is not an area I'm really comfortable trading right now. As I've said all year, I have no interest in trading gold and silver right now. There are other areas of the market. If you want to trade the inverse dollar trade, I think you're much better off with cryptocurrencies. If you want to trade the rebound, you're much better off trading oil. I don't think silver and gold really present us with great opportunities. Now, if you, for whatever reason, are bullish on these metals in the long term, then you might want to look at them as very long-term value plays with the understanding that this could persist for a long time. If we go to the weekly chart, we take a look at what GLD has done. You know, it's very far off the highs, 193. It's all the way down to 161. And so I could see the appeal for someone that's a long-term gold bug, where they would rather, they might want to accumulate here because they consider this to be good value. I personally don't subscribe to this anymore because I think Bitcoin has replaced it as a long-term store value trade. Now, I know a lot of people don't believe in Bitcoin, so they don't really want to take that. And if that's the case, then maybe you want to look at GLD or SLV at their current levels. But I just feel like these are sloppy charts. They don't provide a lot of upside, and they provide plenty of downside. So It's not an area that I'm really that concerned with right now, or an area that appeals to me. Like I said before, and I know not everybody can trade Bitcoin or Ethereum, although I think at this point it's so easily accessible through Coinbase or through even Robinhood that if you are a serious trader, or you're someone that considers himself an active trader and not just someone that wants to buy and hold. Although I think even if you want, even buy and hold is a good, it's something you need to pay attention to. But this has become an asset class that just cannot be ignored and should not be ignored. The volatility is still very, very real, but that plays on both sides. You get the kind of returns with cryptos that you can't get in anything else. And so, just real quick, by the way, for those of you that are in here, if you have a chart you want me to look at, feel free to type it in, and I'll be happy to look at it as we transition away from this back to stocks. But just real quick, I want to point out some of the returns that you could get with cryptocurrencies, and part of the reason why over the last week I've been more involved in this. And also, let me know in the chat if you actually like that I look at these, or if you're not interested in me looking at I'll probably still look at Bitcoin anyway, but if I point out some of the smaller cryptocurrencies, some of the altcoins, let me know if that's something you guys are interested in, or if it's something that I don't know, maybe you guys are just here for stocks and not for some of the smaller altcoins. But there's been some big trends in investing over the last few months, and really it's been in place for a couple years now. But there's been a big move in a lot of crypto areas, and particularly in NFTs, which stand for non-fungible tokens, which we're not going to get into in too much detail here, but just pointing out that there are areas that are exploding with price action, even as the market starts to slow down, or as we see gold and silver really die down. And so you want to be paying attention to this, and you want to make sure that you learn how to access trading with cryptocurrencies, because they are not going away. A lot of big companies like Tesla, recently in the news, are starting to adopt this as and starting to take payments in these forms of currencies, because they have become legitimate stores of value and legitimate currencies that we can trust at this point. In a lot of ways, more than even our own real U.S. dollar fiat currency. Hi Ray, we will take a look at. You said you just heard about C. And then BTCC, I'm not sure if you're talking about the stock Citibank, and then you're asking about Bitcoin. Elaborate on what you're mentioning there for me, please. So Bitcoin here, like I said, has had a big move. It's back up close to all-time highs, and had a really nice bounce. We're going to see the same thing with Ethereum. Had a big bounce. This is something for those of you might maybe, or if you're regulars here, you'll know I pointed out just a couple of weeks ago that I thought Ethereum was a great buy as it broke this wedge. And as you can see, it went from basically 1,500 all the way up to 1,800, which is a pretty nice return for holding something for a couple of weeks. And we're seeing that across the board. So for those of you that maybe have access to Binance, you can see Binance had a big move as well, going from about 225 all the way up to about 300. And there's a lot of these smaller coins, which, like I said, I don't want to go into too much detail, but I do want to point out that I have opportunities here that some people maybe don't have access to because they're not into this. But you take a look at something like Matic. This is one that I've been trading recently, and I was able to pick up a bunch of it at 12, and it's basically tripled. So my entire account has tripled, that held this in the span of basically a month. And it's very difficult to get these kinds of moves in the stock market, but they exist all across the crypto space. And so what I wanted to point out, as I said before, is for those of you that want to do some research and you want to look at non-fungible tokens and NFTs, I'm sure maybe some of you have heard there's a thing called NBA Top Shots that's been in the news a lot recently. Well, there's other ones, and they often have their own blockchain that supports them. And so if you look at something like Flow, which is the one that supports NBA Top Shot, again, you see a massive move from when it started breaking out around $10 a coin all the way up into the 30s and 40s. This is another one, Engine, which is ramped up from 50 cents all the way up to just $2 within the span of a couple of weeks. Rarible is another one, which is an exchange where people sell their own non-fungible tokens. And again, what you can see here is they're all tripling. They're all tripling in price. Doubling, tripling. And so there are opportunities here, massive opportunities that we have for those that are willing to explore different areas and not just kind of get stuck and trying to force the market to give us trades that maybe it's not ready to give us at this time. Um, so, so Ray, you said just heard about C, the Canadian stock. I don't know if I get that here. Let's take a look. Are you talking about? Are you talking about Citigroup or like there's Contact Gold, which I don't think you. Are you saying that Citibank also is accepting Bitcoin? BTCC. Oh, oh, okay. So they have a Bitcoin currency. Okay, so it's a Bitcoin ETF, is what you're saying. Okay. Um, yeah, these things are interesting. I personally am. I'd rather hold Bitcoin over one of these derivative products. Um, Not to say they don't go up because they do. I can't remember the name of it, but there's a Bitcoin. There's a Bitcoin. It's this one. GBTC is an. It's an over-the-counter ETF that also tracks Bitcoin. It's a trust, and it's done incredibly well as well. If you'll notice, it went from 13 all the way to 51. I imagine BTCC is something very similar on the Canadian side. And for people that really can't, for whatever reason, get into Coinbase, this is fine. I mean, it tracks it pretty closely. Um, this BTCC one obviously is brand new, so I don't really know uh, exactly what it's tracking and how well it's going to work, and whether it's going to mimic the volatility. But I would say follow it. But to me, you know, you like I think, and especially friends I have that maybe aren't into trading, they look at something like Bitcoin and they're like, well, it's too expensive. I can't trade this. I can't. One coin is $56,000. But the truth is, you can have fractional ownership of this. You don't actually have to own an entire Bitcoin to trade it. You could just you could own 0.001 of a Bitcoin. You could put in $10 or $30 or $100, and it's going to just it's still based off percentage moves, and so I personally prefer to just put my money in Coinbase or Binance or something else, and then let it actually own the true instrument rather than derivative. But for those that are you have a stock account and you don't really want to be moving money around, I've never seen this one. Obviously, it's only been around for a couple of weeks, so I don't know how well it'll track. Like maybe the GBTC did. Well, which one was it? Yeah, this one, GBTC. But you know, it's up to you to decide which ones you're willing to take the risks with and which ones you aren't. But obviously that one's pretty new, and I don't know how well it's going to track it yet. So it's hard for me to give you any kind of recommendation because, like I said, there just aren't enough candles for me to make any kind of judgment on it. Yes, it's had a really nice move over the last couple of days, going from basically 1080 to 1180, so a dollar move. Um, and Bitcoin has gone basically to $3,000, right? So you'd have to do the math and see whether the percentages line up or not. So yeah, I would keep an eye on it. Right, I don't know that I'd get too aggressive with it yet, Ray. I think I'd want to see more data before I really wanted to go ahead and like trust it. Um, you're gonna have to deal with gaps. That's the other good thing about something trading the actual Bitcoin is it's a 24-hour market cycle. So you don't actually have to worry about if for whatever reason it starts selling off in the after hours. You don't have to wait for a gap up the next day. Okay, you just mentioned it. Well, thank you. But yeah, just pointing out, I personally, in a lot of these situations, I prefer to trade the actual instrument rather than the derivative. But my brother actually trades that ETF as well as the holding real Bitcoin. So he's comfortable with both because depending on the type of account you have, Sometimes you want to have it diversified with stuff in different areas. But I kind of like the fact that with these cryptocurrencies, rather than putting my money on an ETF where I'm not sure how well it tracks the value and worrying about being exposed to gap ups or gap downs, I can go into my Coinbase tonight at midnight and decide I want to switch some stuff around, right? And I might want to be like, I'm kind of tired of this one. I don't like what it's doing, and I'll switch it to this one. And I could just do that in right away with a click of a button at midnight, and not have to worry about waiting for the what's going to happen from here to 9:30 in the morning. But thank you anyway, Ray. I appreciate that. All right, so like I said, for those of you that are in here, I don't know if you actually care about these cryptocurrencies. I think you should. But if you feel like it's a waste of your time, let me know. We can look at stocks more often. But I would hope that you want to expand your horizons and start looking at this stuff, because I think they're providing with great trading opportunities, and it's not going to last forever. At a certain point, the cryptocurrencies will enter another bear market, just like the stock market will. And so adding another area that you can trade just gives you more opportunities and more options when you have certain areas that turn off. So for instance, I'm not happy with the way the stock market has behaved over the last month, but I'm happy with the way cryptocurrencies have behaved. And even they've had a pretty decent correction as well. It's not like they weren't, but they've given cleaner moves than maybe what I've seen with the stock market, and moves that I could trust a little bit more. And if neither one of them are doing something, then maybe I just want to look at the US dollar Canadian or something. And that's another area of the market that I could trade pretty cleanly. And like I said, even if it doesn't give you, a lot of times it doesn't look like a clean move, but there are often clean trends that you could take. Like for instance, what we saw with the US yen, right? And we knew this. For those of you that have been here, we called this. I called this move as it was happening, and it was an extended move. Now, did I expect a break from 106 to 109 this quickly? No, but this was a pretty clean move and a pretty clean transition state. And so, the more areas you're comfortable trading, the more areas that you can comfortably go to when one of the areas is not. Ray, I know you use interactive brokers, but you don't need to just only trade one platform, right? I use interactive brokers. I use Robinhood. I use Coinbase. I use Binance. I use Thinkorswim. I have a lot of different accounts with a lot of different places. Is the majority of my money in one spot maybe versus the other? Sure. But you don't need to say, well, I have IB, I can't trade this. It literally takes 5 minutes to open up a Coinbase account. And you just start with that. You don't have to start with a major position. You just want to learn. And go from there. It's one of those things where it's easy to get tied down and say, well, I have this and they don't offer this. Well, you look for other areas. There's, like I said, you don't need to have 4 different cryptocurrency accounts. You can just have one in Coinbase. But like at the very least, start to expand your horizons and look at other opportunities in other areas. And I do think Bitcoin and Ethereum hold very good long-term value. I trust those two as much as I trust, say, Amazon or Apple. And so not everything is just a swing trade. I think that long-term, those things are just as important as having something like Amazon in your portfolio. All right, guys. Well, that covers it for today. Thank you for those of you that attended. Thank you, Ray, for participating and adding your 2 cents in there. I appreciate it. It's good to see some stuff that I've never seen before. If anyone, like I said, if you guys ever have questions during the week, feel free to ask me on Twitter or ask me on the Discord. I'm more than happy to help out, okay? Other than that, hope you guys have a good rest of this week, and we'll meet again next Wednesday.